Hello, this is the DGI Crab, and thank you for viewing this video. This is the stocks in the Tier 2 group, which is designed for the 31 to 41-year-old investor. So what are the expectations and goals for this particular age range? So you're wanting to look at stocks that have a pretty comfortably above 2% yields. We're going to call that like 2.25% to 3% for the starting yield that you purchase it on. And we do definitely still want to see very consistent dividend growth rate year over year. Maybe not as aggressive as those tier 1 investors in the 18 to 30-year-old range, but we'd still want to see somewhere between 7.5% to 9% for our stocks that we're purchasing in this portfolio year over year. Now, I will say that if there is a lack of value present, if you're looking at just these in this particular group, moving down to that tier 1 group and getting some of those lower yielding but higher compounding stocks is fine if there's better value that exists there. But I will always recommend to anyone, don't chase yield unless you are in your 50s and very, very near that retirement age. You are going to want to focus on year over year dividend growth as opposed to chasing that high starting yield. The high starting yield could be exciting, but the longer you're in the game, the year over year dividend growth rate is going to make a much, much bigger difference. So let's look at our 31 to 41-year-old stocks to focus in on. Again, I'm not a professional investment advisor, so do your own due diligence when investing in any stock. But for the time being, these are the ones that I think are the primary ones to focus on in this particular age range, which is the age range that I fall in, actually. So I focus on these personally. First one up is Air Products and Chemicals Incorporated, stock ticker APD. APD has a market cap of $61 billion. They have been growing their dividend now for 41 consecutive years. And the average annual growth rate for this company is usually about 9 to 11% in most years. Next is Atmos Energy Corporation, stock ticker ATO. Atmos Energy has a market cap of $17 billion and a very solid track record of dividend increases. They've been growing their dividend for 39 consecutive years, and the average annual expectation is pretty consistently in that 7 to 9% a year range, and this is a Morningstar wide moat company. Next is American States Water Company, stock ticker AWR. This is one of the smaller companies by market cap of all of the 60 stocks that this channel focuses on, with just a $2.6 billion market cap. But they have been growing that dividend now for 68 consecutive years, one of the top 5 longest dividend streak companies of any stock on the U.S. stock market. The average annual increase for American States Water is very consistently in the 7 to 9% a year range. A lot of the times it's closer to 9%. So that incredible history overrides the market cap for me as far as that goes, and they make the list. BlackRock Incorporated is next up. The stock ticker is BLK. BlackRock is a massive company with a $114 billion market cap. They have the iShares ETFs that some of you may be familiar with or investing in for that matter. They've been growing their dividend for 14 consecutive years with an annual increase expectation of 8 to 10%, and they are a Morningstar wide moat company. Next is Caterpillar Incorporated, stock ticker CAT. This company makes construction machinery, vehicles, etc. You're probably very familiar with their logo, especially if you're driving through construction. You'll see this logo on a lot of vehicles. They have a market cap of $157 billion, a 30-year history of increasing the dividend year over year. Usually about at a 7 to 9% clip is the expectation, and they are a Morningstar wide moat company. Next up is Cummins Incorporated, stock ticker CMI, with a market cap of $36 billion, an 18-year history of increasing the dividend year to year. And again, a pretty average annual expectation of about 7 to 9%. Very steady company, very well run. Next up is Fastenal Company, stock ticker FAST, one of my absolute favorite stock tickers. How could you not like that one? They have a market cap of $36 billion, recently became a dividend aristocrat with 25 consecutive years of increasing that dividend while also being a member of the S&P 500. They usually increase that dividend at about a 9 to 12% year-over-year clip, and they are also a Morningstar wide moat company. Moving through these quickly, on to the next one, the Home Depot Incorporated, stock ticker HD, needs no introduction. I'm sure you're all very familiar with the Home Depot. They have a market cap of $343 billion. They've increased that dividend for 14 consecutive years, usually at about 9 to 12% a year, and they are a Morningstar wide moat company. Next up is the Hershey Company, stock ticker HSY, with a market cap of $37 billion. It's the largest chocolate confectioner company in the world, or at least in the United States. I don't believe that there's one bigger internationally than Hershey. They've been increasing that dividend for 14 consecutive years with usually about a 10 to 13% increase on average, and Hershey is a wide moat company according to Morningstar as well. Next on the list is Illinois Toolworks Incorporated, stock ticker ITW, the market cap of $70 billion and a 54-year dividend increase streak, putting them on the list and in this tier is an absolute no-brainer with that history. They generally increase that dividend 7 to 9% year over year. Next is JP Morgan and Company. JP Morgan Chase, excuse me, ticker JPM. This is the largest bank on the planet. They could have made the list for that reason alone, but they have a market cap of $556 billion, 9 years of dividend increases. So not an amazingly long streak, but very consistent looking moving forward. They have an annual increase expectation of about 7 to 9%, and they are absolutely a Morningstar wide moat. Next up is Lockheed Martin Corporation, stock ticker LMT, massive defense contractor with a $109 billion market cap. Lockheed has been increasing that dividend for 21 consecutive years. I would be absolutely stunned if 4 years from now they did not join the dividend aristocrats group when they hit that 25-year mark. And they increase that dividend most years between 7 and 9%. Next up is McDonald's Corporation, stock ticker MCD, one of my absolute favorite stocks. And in some ways, this is a kind of a real estate play as well, because as you know, or as you may or may not know, with McDonald's, not only do they sell all of the food and the beverages and the treats and whatnot, but McDonald's owns the land that all of their restaurants sit on as well. They have a market cap of $182 billion with a 48-year dividend increase streak. Very consistently, they increase that dividend by about 9 to 12% a year, and they are a wide moat company as well. Next up is McCormack Company, stock ticker MKC. They have a market cap of $18 billion with a 37-year streak of increasing the dividend. The annual expectation most years is 8 to 11%, and they are a Morningstar wide moat company as well. Next is Nextera Energy, stock ticker NEE. This utility company has a market cap of $150 billion, a 28-year streak of increasing that dividend with an annual increase expectation of 9 to 12%. Next up, this one should be familiar to everyone, Starbucks Corporation, stock ticker SBUX. Starbucks has a market cap of $90 billion, a 13-year dividend increase streak, usually at about a 7 to 10% clip, and they are a Morningstar wide moat. Next is Target Corporation, ticker TGT. Target has a market cap of $65 billion with a very impressive history of increasing the dividend with 55 years consecutively. Usually you could expect an annual increase of about 8 to 11%, but as of the date of this recording, they have had a couple of sort of disappointing dividend increases, but they're certainly planning on keeping that impressive 55-year streak going for many more years to come. So they're not going to get out over their skis and provide a big increase in years where they feel like maybe they need to be a little bit more conservative, and I'm okay with that. I think they'll get back to larger increases in the coming years. Next up is Texas Instruments Incorporated, stock ticker TXN. They make a lot more than those little calculators that we used in high school and in college. They have a market cap of $176 billion, an 18-year dividend increase streak at an average rate of about 8 to 11%. And TXN absolutely is a Morningstar wide moat company. All right, and then now we have the Union Pacific Corporation, stock ticker UNP. This is the largest railroad in the United States. They have the most tracks laid down of any of the railroad companies in the country. Massive market cap of $135 billion, a 17-year streak of increasing the dividend. The annual increase expectation is about 8 to 11%, and with all those tracks laid down, they're definitely a Morningstar wide moat company. And then a little note on Union Pacific. A lot of years, they actually do 2 dividend increases over the course of the year, one every 6 months. Not something that they may do consistently moving forward, but that's certainly something that they have a pretty strong history in doing so far. So that's kind of just a little fun fact about this one if you're tracking them very closely. So that is our list of the 31 to 41-year-old stocks that you can sort of focus in on. Tier 2 is the largest of the tiers that I have in terms of the number of stocks that are available. Lots of household names, a lot of consistency in their dividend increases, and it's absolutely, as with all the tiers, these stocks are about sleeping well at night. That you can invest in and feel confident in that the companies are going to continue on with their long track records of increasing their annual payouts and increasing your passive income almost regardless of market conditions. With any individual stock, we're going to focus in on buying these only when we perceive them to be on sale, which means that their current dividend yield would be about 20% higher than their 4-year average at least. And if you're doing that, you'll certainly be getting a starting dividend yield much closer to the 3% we're looking for than the 2.25. But that is the list. I am Colby, the DGI Crab. Email me any questions that you have at dgicrab@yahoo.com. Check out the links in the description below to some of the other videos. And remember to like and subscribe, and I will see you on the next one.